Before we turn to the main subject of this week's video, I received several comments from viewers who are relatively new to seeing candlestick charts used by professional traders. We use candlestick charts regularly because they contain important information about the battle between bulls and bears on price. This is an example of a candlestick chart. Time is recorded on the horizontal axis, and price is recorded on the vertical axis. Price movement for each unit of time is represented by a candlestick. Candlesticks are very easy to understand, and I'm starting with a brief overview. If you're already familiar with candlesticks, you can skip ahead a minute or two to this week's main topic. In its simplest form, candlesticks tell us whether price closed higher or lower than where it opened. On a green day, price opens, and the closing price is higher than the open. The body of the candle is the rectangular portion between the open and close. The lowest price below the open is shown by the lower shadow, and the highest price above the close is shown by the upper shadow. The upper and lower shadows are also referred to as wicks, since we're talking about candlesticks. A red day is simply the reverse of a green day. On a red day, price opens higher and closes lower by the end of the day. Again, we have the body between the open and the close. We have an upper shadow with the highest price above the open, and we have a lower shadow with the lowest price below the close. A series of candlesticks shows us the direction of price over time. There are three universal truths of price movement. From yesterday to today, price can only move up, sideways, or down. There are no other possibilities. Day to day, going back to 1928, the odds of a red or green candlestick are roughly 50-50. However, a series of candlesticks provides us with rich information about a trend. Since price only moves up, down, or sideways, price tends to move in a series of broadening formations or inverted triangles. This is a concept we frequently use in our charting. This quote by Christopher Davis not only speaks to the importance of recognizing that corrections are part of investing, but also speaks to the importance of having a model for keeping a firm hand on the tiller during times of market turbulence and having the knowledge to differentiate between corrections and the end of a trend. Our strategy is long-term trend following. We don't make predictions. We use evidence and our model to determine probable outcomes and stay on the right side of the market trend. If you've watched prior videos, you'll recognize the next two charts, so we'll move through them quickly. Our goal is to capture the primary trend and avoid the downside. We have to buy when a bottom is confirmed and the upward trend begins, and we sell after a top is confirmed. As a premium for confirmation of the start and end of a trend, we may give up the first 5 to 10% of the beginning and end to potentially capture 80 to 90% of the trend. This quote by Warren Buffett is applicable to trend following and highlights the value of buying the trend early versus buying the trend late. To be able to capture as much as possible of the primary trend, we have to recognize that the intermediate trend has countertrends. We have to distinguish countertrends from market tops. Fundamental analysis and technical analysis can provide us with evidence to determine probable outcomes. A tool that we'll look at from a technical perspective is the concept of fractals. Fractals are a mathematical concept used in technical analysis. A fractal is a pattern that repeats itself on smaller and smaller timescales. This is a familiar chart from previous videos showing a large pattern in the market that you can recognize. Over a very long period of time, going back to 1927, we see that there's a pattern of decades of sideways consolidation followed by decades of long bullish trends. Notice that each period of sideways consolidation also has a spike low where investors panicked or sold out. These are labeled as false breakdowns. Each one of these instances marked a bottom where the bullish trend resumed. The upper right of the price chart is where we are today. You already saw how there was a large repeating pattern over decades on the previous slide. Now we'll use the concept of fractals to show how the same pattern can repeat on a smaller time scale of years. Here is the middle of the decades-long pattern. And now you can see the smaller fractal version of the pattern that unfolded from 2013 to late 2017. In the upper right-hand corner, we're likely going through a fractal consolidation or correction that began in late January 2018. If we zoom in on the period from 1996 through 2018, you can see the decades-long consolidation from 1997 through 2013. Most of us who are far along enough in our careers to have accumulated wealth don't have an investment time horizon of decades. Trend following seeks to profit from the upside and avoid the downside on an appropriate time frame for you. During this consolidation, there was a 50% loss from the dot-com bust and a 58% loss from the 2008 global financial crisis. Here's the smaller or fractal consolidation on a multi-year time frame. So in order to gain 331% from the start of the trend in 2009 to January 2018, you had to recognize the larger pattern and the smaller pattern or fractal that resulted in a 15% loss in 2015 through 2016. If you recognized the trend early and bought it in 2009, by 2015, you had a 291% gain. That makes giving up 15% easier to handle if you have a model that tells you there's a significant probability of substantial additional upside. Similarly, we use our model to determine the probabilities of the current correction. The evidence fed into the model this week indicates that we are not in the clear yet, but the probabilities of additional upside are improving. Since fractals repeat on smaller and smaller timescales, let's zoom in a little closer. From July of 2016 to January 2018, there was a gain of 34.8% prior to the current correction, which resembles what we call a symmetrical triangle pattern. This pattern could change into a descending triangle, which is more bearish, but it hasn't yet. We can learn about probable outcomes by looking at additional pieces of visual evidence. To be clear, these visual representations are not used in our model. By comparing 2008 to 2018, we can see that the moving averages cross over later in the start of bearish trends. In 2018, we can see that the moving averages have not crossed over. Since fractals repeat on smaller and smaller timescales, let's zoom in a little closer. From July of 2016 to January of 2018, we see strong spreads between the moving averages, showing that the primary trend is intact. If we look at the current correction, we can learn something from the candlesticks. Notice that many of the candles in the weekly chart have long lower wicks. The long lower wicks show us that the bulls are buying on the dips. Selling pressure is showing signs of having been wrung out of the market, paving the way for a potential path to the upside over time. On this daily chart, you can see that as of noon on Friday, we've cleared several key levels, including some important monthly closes. Now that we've cleared some of these overhead levels of resistance, it makes sense that we may go back and retest a level to confirm that it is now support. We still have to break out of the symmetrical triangle that we covered last week. As of the time of this recording, it seems quite likely that we'll clear the resistance at 2650 that we had noted last week. This increases the probability of breaking the upside of the symmetrical triangle and going on to make higher highs. We're certainly not out of the woods yet, but the conclusion of this week has improved our model scores and the probability of favorable outcomes. Remember, we use evidence and don't maintain bullish or bearish views. We will sell to bulls and buy from bears when the evidence supports it. If the evidence changes, we'll change accordingly. In the interim, we're sitting comfortably in our long positions. A longer-term perspective is helpful. You need to step back from the current correction and see where we are in the big picture. It's hard to buy when everyone is panicking, unless you have a model to help you understand if there's truly a fire or if someone is yelling fire in a crowded theater. Should conditions change, our model scores will change, and we have a list of defensive assets that we would move into incrementally. At this time, the current movement is to the upside, but we're well prepared for either outcome. Next week will likely hold additional surprises, and this quote from last week still applies. We have a plan for the evidence as it unfolds either way. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.